Bum, bum, ba, bum, 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 bum. Hey, this is a fun day, huh? I've been testing your patience. Wait, doesn't look like. Oh no, we are. All right. So hey, I've been testing your patience lately, haven't I? Well, this isn't me. This is YouTube. Yeah, it's just one of those things. But what I'm trying to get at is when we get to GDP at the Fed, it's not as simple as you would expect. Hey, Ronnie. Um, so TRADARS 2.0 just goes into the database. And we actually have to mathematically calculate the answer. The change of quarterly GDP over 6 months. So you have to look at this GDP, the last GDP, relative to the annual GDP. You see what I'm getting? And then suddenly we can tell you what GDP is. So actually, the most simple basic thing is not that simple, but we make it simple for you. So I think that actual particular data point is actually broken. But now you understand why, like, that it may glitch. So here we go. We got 3.8, but only one. So by next, by Monday, let's say, this will all be done. Huh? Right, this will be fixed. But you can see we've done our calculation. So quite literally, we pull this data. Okay, we pull this data, and we zoom in, and we have to look at this 29,147 millions, okay, to 30.45, but then do it quarterly. So you have all of this, you have to do all the math, and when you do the month, because it's quarterly GDP over 1 year. So you have to calculate, you see? So you get the quarterly over the annual chain. And what's the answer to that? 3.8. Huh? Are you happy that I'm doing this for you instead of you having to do this? You're like, Wayne, I thought you'd just pull this out of database. It's 3.8. Yeah, I wish, bro. I wish. But for all these other things measuring the economy, like what's the consequence of too much money in the economy? Here we see it in a different way. So I showed you inflation, I showed you wage growth, I showed you jobs, I showed you job openings. We looked at a lot of different things, right? Now we're looking at the consequence of too much money in the economy. How did that impact retail sales? Well, can you see it? There it is. Does that look strange to you? Yeah. It went to negative to then extraordinarily positive. And you're like, that's weird. Yeah. And normal used to be 3, and now we're somewhere between 4 and 5.5. There's still too much money, y'all. Now the other problem is this, and it's not a problem with us. It's just this is a calculation in dollars, so it doesn't tell you, okay, you're spending lots of money relative to what we used to spend. I mean, think of it. You're like, well, Wayne, what's the big deal? What's the difference between 3 and 4? 33%. Now, what if it bought you the same amount as it used to? Then you have 33% inflation relative to 2019. And that's what I was talking about earlier. 3 webinars ago. You mean, Wade, that was only 40 minutes ago. Yeah, well, 40 minutes ago, three live streams ago. Thank you, YouTube. But now do you see how important it is to have the data? So now we're looking at our third measure of the consequence of quantitative easing and government stimulus. And the net output here is the government is telling you that inflation is back to basically normal. It's 3. They want it to be 2, but 3 is not 10. So they're like, okay, that's pretty much fixed. No, it's not. And that everything is back to normal, and the 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 economy is healthy because the consumer is still spending. The reason I have retail sales here is I'm trying to calculate GDP. So I need the C, the I, and the G, and I need some net export data, which is coming. All right. So therefore, we can actually calculate GDP on our own using our own quantitative data. But because now you're empowered, now you can say, okay, government, you told me inflation is back to basically normal and the consumer is healthy, so there's nothing to worry about. You're like, but it's what if the 33% increase in spending bought you nothing more than it used to? Then inflation is actually fixed inflation is at 33%. And you're like, yeah, that's what it actually feels like. But that's not what the government is telling me. Uh-huh. So now here's our projection for industrial production capacity utilization. That's our manufacturing sector. Okay. Isn't it cool that we have 15 years of manufacturing data? Yeah, it's cool, right? So what does it mean? Our factories are currently running at 77. Well, that's the implied low. 77.4%. So you see it's pretty stable and expected to stay stable. But we're running our factories in America are running at 3/4 their capacity. Seems like you could add one more shift, right? There's a day shift, there's a night shift, but there's no morning shift. Something like that, right? Like we could do more. Well, why can't we do more? Why can't we do more if there's more money and more spending? Because the more money didn't help. You're spending more money to get less. So you could kind of say, well, maybe inflation is closer to 25%. Well, you could argue that. It's not really the right way, but it gives you a similar outcome. You're like, wait, if we have more money than God and more spending than ever, why are the factories moving at 3/4 capacity? Because you're getting 25% less than for the same amount of money. Okay. Remember your first iPhone? What did it cost you? 300 bucks? Then it was 500 bucks? Then it was 700 bucks? Now and then it was what? 800 and then it hit 1,000? How much are you spending on your iPhone now? Are you spending 1,000 bucks on your iPhone? By the way, it costs 20 bucks to make. Doesn't that piss you off? Well, you're the one spending $1,000 on a $20 phone. But it cost $1,000. So did the iPhone really get that much better? It's AI ready. What does that mean? It's AI ready. Yeah. So anyways, so maybe it's just the value of your dollars. Okay. Maybe you have more money than ever, but it buys you less. Yeah, well, that's not what you want. You want capitalism. Capitalism is good because capitalism doesn't use money. Money is a unit of account. It Money is a medium of exchange. So if you don't have any exchange, you're going to need more money. Well, we want the exchange part. That's where capitalism thrives. So if you work for, let's say, a factory, let's say it didn't pay you very much to work in the factory. You're like, well, Wayne, that's not fair. Why? Well, you should pay somebody a living wage. Well, I didn't say that. I said you just don't make much money. But what if you lived in a nice apartment and you had nice furniture and a big old TV? You can afford healthy food. You can lease a half decent car. And your life is pretty gosh darn good for a factory worker. You don't have a PhD. You're not interested in bringing your work home and worrying all night, working weekends. You go there, you work the factory, you go home and you live in a nice, safe neighborhood in a nice apartment. You have nice stuff. You don't have anything to worry about. So all of a sudden you're like, well, Wayne, that's an ideal life. That's actually quite rich. Yeah, but I don't pay you much money to work at my factory. You don't need much money to live. So you have a living wage, even though it's not much money. This goes back to like in 1960, you made $25,000 a year salary, but you could afford a brand new car and a decent house to raise your children. But you only made 25 grand. You can't even buy a car in the United States for 25 grand. A new car? There isn't even a new car. And when you show up to the car dealership and they're like, we have a brand new Kia, whatever, and it's starting at 35,000. You're like, wait, that doesn't include door handles? It doesn't include windshield wipers? It doesn't include carpets? Wait, there's no GPS? They're like, yeah, in fact, we don't have any of those $30,000 cars, but if you want the one with windows and carpets and a GPS, um, yeah, that's going to be 42,000, right? And all of a sudden, but back in the day, your car would be 2,000 bucks, and you only made 25. So you were richer at 25,000 than now at 50 or something, right? Because to stay the same, if you made $50,000 now relative to 25,000 then, the thing is then a brand new car would cost you 4,000 bucks. You're like, dude, no, it's 40,000 bucks. So you're 10 times more poor than your grandfather was. Yeah. Yeah. So anyway, hey, coming up. Why don't I pull that up and we can watch the press conference? You guys good? Hey, sorry for the YouTube problems, but I must say, it ain't me. It ain't me. It ain't me. I ain't no fortunate boy, no. Let's see. We're pretty close, right? Yeah, we're 90 seconds away. Let me. Oh, did you see that? The the crane just moved right in front of the camera. That's a live feed. Completely unnecessary. I could just be an image. Yeah, I stood there with my wife. Good memories. Can you hear the music? You should be able to. But I don't know what the hell's going on here. But we know the key things. They cut. Okay, they cut, and they're ending quantitative tightening. So my big question would be, will the Fed likely, because of the lack of data, even if the government reopens, there's going to be a lack in trend of data. Would the end of quantitative tightening be considered a Fed cut in December, or replace a Fed cut in December?
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. Although some important federal government data have been delayed due to the shutdown, the public and private sector data that have remained available suggests that the outlook for employment and inflation has not changed much since our meeting in September. Conditions in the labor market appear to be gradually cooling, and inflation remains somewhat elevated. In support of our goals and in light of the balance of risks to employment and inflation, today the Federal Open Market Committee decided to lower our policy interest rate by a quarter percentage point. We also decided to conclude the reduction of our aggregate securities holdings as of December 1. I will have more to say about monetary policy after briefly reviewing economic developments. Available indicators suggest that economic activity has been expanding at a moderate pace. GDP rose at a 1.6% pace in the first half of the year, down from 2.4% last year. Data available prior to the shutdown show that growth in economic activity may be on a somewhat firmer trajectory than expected, primarily reflecting stronger consumer spending. Business investment in equipment and intangibles has continued to expand, while activity in the housing sector remains weak. The shutdown of the federal government will weigh on economic activity while it persists, but these effects should reverse after the shutdown ends. In the labor market, the unemployment rate remained relatively low through August. Job gains have slowed significantly since earlier in the year. A good part of the slowing likely reflects a decline in the growth of the labor force due to lower immigration and labor force participation, though labor demand has clearly softened as well. Although official employment data for September are delayed, available evidence suggests that both layoffs and hiring remain low, and that both households' perceptions of job availability and firms' perceptions of hiring difficulty continue to decline. In this less dynamic and somewhat softer labor market, the downside risks to employment appear to have risen in recent months. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer-run goal. Estimates based on the Consumer Price Index suggest that total PCE prices rose 2.8% over the 12 months ending in September, and that, excluding the volatile food and energy categories, core PCE prices rose 2.8% as well. These readings are higher than earlier in the year as inflation for goods has picked up. In contrast, disinflation appears to be continuing for services. Near-term measures of inflation expectations have moved up on balance over the course of this year on news about tariffs, as reflected in both market and survey-based measures. Beyond the next year or two or so, however, most measures of longer-term expectations remain consistent with our 2% inflation goal. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to lower the target range for the federal funds rate by a quarter percentage point to 3.75% to 4%. Higher tariffs are pushing up prices in some categories of goods, resulting in higher overall inflation. A reasonable base case is that the effects on inflation will be relatively short-lived, a one-time shift in the price level. But it is also possible that the inflationary effects could instead be more persistent, and that is a risk to be assessed and sure that a one-time increase in the price level does not become an ongoing inflation problem. In the short term, risks to inflation are tilted to the upside and risks to employment to the downside.
There we go.
A challenging situation. There is no risk-free path for policy as we navigate this tension between our employment and inflation goals. Our framework calls for us to take a balanced approach in promoting both sides of our dual mandate. With downside risks to employment having increased in recent months, the
I did a
balance of risks
volume
has shifted.
booster.
Accordingly, we judged it appropriate at this meeting to take another step toward a more neutral policy stance. With today's decision, we remain well positioned to respond in a timely way to potential economic developments. We will continue to determine the appropriate stance of monetary policy based on the incoming data, the evolving outlook, and the balance of risks. We continue to face two-sided risks. In the committee's discussions at this meeting, there were strongly differing views about how to proceed in December. A further reduction in the policy rate at the December meeting is not a foregone conclusion. Far from it. Policy is not on a preset course. At today's meeting, the committee also decided to conclude the reduction of our aggregate securities holdings as of December 1. Our long-stated plan has been to stop balance sheet runoff when reserves are somewhat above the level we judge consistent with ample reserve conditions. Signs have clearly emerged that we have reached that standard. In money markets, repo rates have moved up relative to our administered rates, and we have seen more notable pressures on selected dates, along with more use of our standing repo facility. In addition, the effective federal funds rate has begun to move up relative to the rate of interest on reserve balances. These developments are what we expected to see as the size of our balance sheet declined and warrant today's decision to cease runoff. Over the 3.5 years that we've been shrinking our balance sheet, our securities
Look
holdings
at the
have declined
7-year yield.
$2.2 trillion. As a share of nominal GDP, our balance sheet has fallen from 35% to about 21%. In December, we'll enter the next phase of our normalization plans by holding the size of our balance sheet steady for a time, while reserve balances continue to move gradually lower as other non-reserve liabilities, such as currency, keep growing. We will continue to allow agency securities to run off our balance sheet and will reinvest the proceeds from those securities in Treasury bills, furthering progress toward a portfolio consisting primarily of Treasury securities. This reinvestment strategy will also
They're getting rid of
move the
MBS.
weighted average maturity of our portfolio closer to that of the outstanding stock of Treasury securities, thus furthering the normalization of the composition of our balance sheet.
So they're moving from the 30-year to the
The Fed
10-year.
has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to supporting our maximum employment, bringing our inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored.
That's why you see the
Our
10-year
success in delivering
down
on these goals
and the
matters to
30-year
all
up in the
Americans.
green and the
We
red bars.
understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Nick Timmeros of the Wall Street Journal. Chair Powell, are you uncomfortable with how market pricing has assumed a rate cut is a foregone conclusion at your next meeting?
Well, as I just mentioned, a further reduction in the policy rate at the December meeting is not a foregone conclusion, as I've just said. So I would say that that needs to be taken on board. We had, just say this, 19 participants on the committee. Everyone works very hard at this and takes their obligations to serve the American people very seriously. And at a time when we have tension between our two goals, we have, strong views across the committee. And as I mentioned, there were strongly differing views today. And the takeaway from that is that we haven't made a decision about December, And, we're going to be looking at the data that we have.
See?
That affects the
See?
outlook and the balance of
So the
risks.
QT is the rate
just
cut
say
in
that.
December.
You and some of your colleagues have framed last month and maybe today, I won't put words in your mouth, there's a risk management exercise. At what point do you conclude that you've taken out enough insurance? Are you looking for some kind of improvement in the outlook? Or could this unfold along the lines of last year, where you made a sequence of adjustments and then waited to gather more information?
So the way I've been thinking about it is the risks to the two goals. For a very long time, the risk was clearly of higher inflation. And then that has changed now. And as we saw particularly after the July meeting, we saw the downward revisions in job creation, we saw a very different picture of the labor market, and suggested that there were higher downside risks to the labor market than we had thought. And that suggested that policy, which we had been holding at a I would say modestly, others people would say moderately restrictive level, needed to move more in the direction over time of neutral. If the two goals are sort of equally at risk, then you ought to be at neutral, because one of them's calling for you to hike and one of them's calling for you to cut.
He's
So
talking
if
about the
that-
job
if that
market.
got back
This
into
is what he's
balance,
talking
then
about.
you want to be roughly at neutral. So in that sense, it was a risk management. And I
We
would say
have
the
an
same about today.
implied
Sort of the
negative
same
NFP.
logic. But as I mentioned, going forward is a different thing.
Claire. I'm Claire Jones, Financial Times. Thank you for taking this question. We've just heard from you that the
Yes, Mahai.
discussion in December and the conclusion of the discussion is not a foregone conclusion. I'd like to just dig into that a little bit more about what sort of arguments were brought up. Was there any consideration, for instance?
You're looking at it.
the
This is TRADARS
investments we're
2.0.
seeing in AI and some of the generation of household wealth through rises in stock prices related to the AI boom? Thank you.
I wouldn't say that's a factor in everyone's assessment of the economy. I wouldn't say it's the driving factor, I don't think, for anybody. I guess I would say it this way. Once again, I would just point out that we have the situation where the risks are to the upside for inflation and to the downside for employment. We have one tool. It can't do both of those. You can't address both of those at once. You've got a very different situation. So you have some people have different forecasts, right? So they'll forecast faster or slower progress on one or the other. And they also have different levels of risk aversion. And, some will be more averse to inflation overruns, and some will be more averse to underruns of employment. And so you put that together, and as you can see from the SEP and from the public discussion that goes on between the meetings when participants go out and talk, they're very disparate views. And they were reflected in strongly differing views in today's meeting, as I pointed out in my remarks. And that's what leads me to say that, that we haven't made a decision about December. I always say that. It's a fact that we don't make decisions in advance. But I'm saying something in addition here, is that it's not to be seen as a foregone conclusion. In fact, far from it.
Yeah, that's what I
Just a
mean.
quick
With
follow-up on
QT ending
How
in
much
December,
of
that was the compromise.
The fund impressions
Okay,
we've
we
seen in
won't
money
cut,
markets
but we'll
related
stop
to the
QT.
US Treasury issuing more short-term debt.
That could be one of the factors, but the reality is we've seen, the things that we've seen, higher repo rates and federal funds rate moving up. These are the very things that we look for. We actually have a framework for looking at, what the place we're trying to reach. What we said for a long time now is that when we feel like we're a little bit or a bit
By the way,
above,
did you notice TRADARS
what we
is free?
consider a level that's ample, that we would freeze the size of the balance sheet. Of course, reserves will continue to decline from that point forward as non-reserve liabilities grow. So this happened, some things have been happening for some time now, showing a gradual tightening in money market conditions. Really in the last, call it 3 weeks or so, you've seen more significant tightening, and I think a clear assessment that we're at that place. The other thing is, the balance sheet is shrinking at a very, very slow pace now. We've reduced it by half twice. And so there's not a lot of benefit to be holding on to get the last few dollars because, again, the balance sheets, the reserves are going to continue to shrink as non-reserves grow. So there was support on the committee as we thought about it to go ahead with this. And
Oh, I know what happened, Mahai. I'll be able to fix that. Go ahead and
freezing
email
the
me.
size of the balance sheet. And the December 1 date gives the markets a little bit of time to adapt.
Colby. Thank you, Colby Smith with the New York Times. So much of the rationale for cutting interest rates, even as inflation moves away from the 2% target, seems to be, that there are these mounting downside risks to the labor market. But if those don't materialize and the labor market either stabilizes around current employment levels or even starts to strengthen somewhat, how would that change your perception of how much interest rates need to fall from here? Would you then be a bit more concerned about underlying inflation and the possibility of second-round effects from tariffs?
Yeah, I mean, in principle, if you were to see data that suggested that the labor market's strengthening or even that it's stabilizing, that would certainly play into our decisions going forward. So, and we do have, we get some data. The labor market is a place where we get, for example, we get the state-level data on initial claims, which are sending a sort of a signal of more of the same. We also get job openings. And we'll get lots of survey data. We'll get the Beige Book and things like that. So we'll have a picture of what's going on in the labor market. And the fact that we're not seeing an uptick in claims or a downtick really in openings suggests that you're seeing maybe continued very gradual cooling, but nothing more than that. So that does give you some comfort.
But if this shutdown lasts a while longer and you don't have that data in hand, I'm just wondering how that hinders the committee's ability to assess the state of the labor market and make the right policy decisions, and also how much is that factoring into the debate about December?
Yeah. So we get like I mentioned what we get in the labor area. We get some data in inflation, some data in economic activity. And we'll have a picture of what's going on. We also will have the Beige Book again. I would say we're not going to be able to have the detailed feel of things. But I think if there were a significant or a material change in the economy one way or another, I think we'd pick that up through this. So in terms of how it might affect December, it's really hard to say. December's the meeting's like 6 weeks away. We just don't know what we're going to get. If there is a very high level of uncertainty, then that could be an argument in favor of caution about moving, but we'll have to see how it unfolds.
Steve.
Steve Leisman, CNBC. Mr. Chairman, can you characterize the meeting in terms of, you said strongly differing views. Was this a close call, this cut, or was it a close call maybe the other way because you had dissents on both sides? Thanks.
So I was referring to the discussion about, to the extent it related to December. You saw we had 2 dissents, one for 50 and one for no cut. So, that was a strong, solid vote in favor of this cut. The strongly differing views were really about the future. What does that look like? And I think people are saying, they're noticing stronger economic activity. Forecasters generally, broadly, have raised their economic growth forecasts for this year and next year, in some cases quite materially. In the meantime, we see, a labor market that's kind of, I don't want to say stable, but it's not clearly in motion. It's not clearly declining quickly in any case. It may be just continuing to gradually cool. And again, people have different forecasts and expectations about the economy and different risk tolerances. And so there's you read the SEP, you read the speeches, there are differing views on the committee, and to the point where I said what I said.
And just to follow up on the balance sheet, if you stop at the runoff now, does that mean you have to go back to actually adding assets sometime next year so that the balance sheet doesn't shrink as a percent of GDP and become a tightening factor?
So you're right. The place we'll be on December 1 is that the size of the balance sheet is frozen. And as mortgage-backed securities mature, we'll reinvest those in Treasury bills, which will foster both a more Treasury balance sheet and also a shorter duration. So that's what, in the meantime, if you
See,
freeze
that's
the
what I
size of
mean
the
by
balance
going
sheet,
from the 30 to the
non-reserve
10.
liabilities, currency, for example, they're going to continue to grow organically. And because the size of the balance sheet is frozen, you have further shrinkage in reserves. And reserves is the thing that we're managing that has to be ample. So that'll happen for a time, but not a tremendously long time. We don't know exactly how long. But at a certain point, you'll want to start reserves to start gradually growing to keep up with, the size of the banking system and the size of the economy. So we'll be adding reserves at a certain point. And
This
that's-
is what I'll
that's
be
the last
teaching
point.
soon.
Even then, we didn't make decisions about this today, but we did talk today about the composition of the balance sheet. And there's a desire that the balance sheet be, right now, it's got a lot more duration than the outstanding universe of Treasury securities. And we want to move to a place where we're closer to that duration. That'll take some time. We haven't made a decision about the ultimate endpoint, but we all agree that we want to move more in the direction of a balance sheet that more closely reflects the outstanding.
So he's dumping
Treasuries and
mortgage
that shorter
securities.
duration, balance sheet. Now, this is something that's going to take a long time and move very, very gradually. I don't think you'll notice it in market conditions, but that's the direction of things.
Janelle.
Janelle Marte with Bloomberg. How are officials interpreting the latest CPI report? So some components came in lower than expected, but core inflation was still at 3%. So at this moment, what are you learning about the drivers? And also, do you view that the risks are greater that the Fed makes a mistake on employment or inflation?
So the September CPI report, we didn't get PPI after that, which is important for translation into what we look at, which is PCE inflation, but we can still make a pretty good assessment of what that will be. When we get PPI, there might be some adjustments, but so directionally, it was a little softer than expected, and we always break it down into the three components. So basically, you've seen goods prices increasing, and that's really due to tariffs. And that's compared to a longer run trend of very, very mild deflation in goods. So that's moving inflation up. On the other side of that, good news, that housing services inflation has been coming down and is expected to continue to come down. So if you remember a couple of years ago, that's the one that we kept.
He's talking about
expecting it
mortgages.
to do that. Now it's been doing that for some time, and we expect to continue that. That leaves the biggest category is services other than housing services. And that's kind of been moving sideways over the last few months, but a significant part of that is non-market services, and we don't take a lot of signal about the tightness of the economy from that. So if you add all that up, a couple things to say. One is that inflation away from tariffs is actually not so far from our 2% goal. We estimate, people have different estimates of what that is, but it might be, 5 or 6 tenths, and so that, if it's 2.8, then core PCE, not including tariffs, might be 2.3 or 2.4 in that range, something like that. So that's not so far from your goal. So that we look at that, and the thing about tariff inflation is the base case is that it will come, and it probably will increase further, but it is that it will be a one-time increase. And, we've been very focused for all of this year at making sure that that's the case and thinking carefully about what are the pathways through which it could become something else, troublesome inflation. One of those would be, a really tight labor market. We don't see that. Another could be inflation expectations moving. We don't see that. So I think, we're watching this very carefully. I think it's not the case that we're just assuming that it's going to be a one-time inflation. We understand fully that this is a risk we have to monitor and ultimately manage.
With the stubborn in services inflation, what are some of the things that the Fed could do to address that, and especially when we're seeing potentially labor supply challenges?
Sorry, say the first.
The stubborn services inflation that you mentioned.
Services inflation, yeah. Well, again, the part of services inflation that isn't coming down as we would like it to is the non-market part of non-housing services. And, overall, that's just something that we expect will come down. The non-market part of it should come down. It largely reflects higher stock prices and financial services that are imputed rather than actually paid is a big part of that. But also just, we think policy is still modestly restrictive in my telling. So that's the kind of thing that should lead to a gradually cooling economy. That's one of the reasons you see a gradually cooling labor market, is because Fed policy is modestly restrictive. So that should also help get that. I want to say, though, we're absolutely committed to returning inflation to 2%. If you look at longer-term surveys or market pricing, you will see that's a credible commitment, and there should be no question that that's where we're going.
Chris.
Great, thank you. Chris Rugaber at Associated Press. So there's a big investment boom in AI infrastructure right now, as you know, and wondering if the existence of such a boom would indicate that rates are not that restrictive after all, and could further rate cuts at this point perhaps fuel an excess level of investment there or market bubbles? How is the Fed thinking about that?
So I don't think that you're right. There are a lot of data centers being built and other investments being made around the country and around the world. Big U.S. companies are just investing a lot of resources in thinking about how AI, which will be based on those data centers, run through those data centers, is going to affect their businesses. So it's a big deal. I don't think that the spending that happens to build data centers all over the country is especially interest sensitive. It's based on longer run assessments that this is an area where there's going to be a lot of investment and that's going to drive higher productivity and that sorts of things. I don't know how those investments will work out, but I don't think they're particularly interest sensitive compared to some of the other sectors.
And then just a quick follow-up. You mentioned that you do have data that you're looking at for inflation and growth in the absence of government data. Could you give us a sense? I think we know a lot about the jobs data that's out there. Can you give us a sense of what you're looking at to track inflation in the absence of government data? Thank you.
So it's a lot of things, and it doesn't replace government data, but you know all of these. I'll just mention some of the many names: Price Stats, Adobe, and others. For wage inflation, there's ADP data. On spending, you're going to ask about spending at some point. There are lots of other things that we look at, but it's many different sources, and again, including what we get out of the Beige Book, which will be sort of come out mid-cycle as always. And it doesn't replace.
Look at the pivot points.
Government data, but it gives us a picture. Again, I think if something material were happening, if there were material developments, I think we would pick that up. I don't think we'll be able to have the very granular understanding of the economy while this data is not available.
Howard.
Howard Schneider with Reuters. Thank you. I just wanted you to elaborate a little bit on what you said a moment ago about a continued shutdown, making it more difficult to make a move in December, and that may make you more cautious. To the degree you are relying on private data that isn't the gold standard, or that you're relying on your own surveys of the Beige Book, do you worry at some point you're going to have to start making policy by anecdote?
This is a temporary state of affairs, and we're going to do our jobs. We're going to collect every scrap of data we can find, evaluate it, and think carefully about it. And that's our jobs. That's what we're going to do. If you ask me, could it affect the December meeting? I'm not saying it's going to, but yeah, you could imagine that what do you do if you're driving in the fog? You slow down. So that could or could not. I don't know how that's going to play into things. We may get the data may come back, but there's a possibility that it would make sense to be more cautious about moving. I'm not committing to that. I'm just saying it's certainly a possibility that you would say we really can't see, so let's slow down.
As a follow-up, in the debate on this meeting, we saw recently some pretty big layoff announcements coming from
So you just
Amazon.
said we don't have the data, so
Wondering
we
if
should
that
probably
figured into the
stop
discussion
cutting.
at all, that you're starting to see this tension between growth and employment starting to be resolved, to the detriment of employment. And secondly, some of the stress is starting to appear in the bottom spur of the K, as they call it, household health premiums that are going to possibly be going up quite substantially, things like that. Has that started to become a factor in your policy discussion?
So those are both things that we're watching very, very, very carefully. To start with the layoffs, you're right. You see a significant number of companies either announcing that they are not going to be doing much hiring or actually doing layoffs. And much of the time, they're talking about AI and what it can do. So we're watching that very carefully. And, you know, yes, it could absolutely have implications for job creation. We don't really see it in the initial claims data yet. Now, it's not a surprise that we don't. It takes some time for it to get in there, but we're watching that really carefully. But again, don't see it yet in the initial claims data. On the K-shaped economy thing, I would say the same thing or similar thing. We are, if you listen to the earnings calls or the reports of, you know, big public consumer-facing companies, many of them are saying that there's a bifurcated economy there, and that consumers at the lower end are struggling and buying less and shifting to lower-cost products, but that at the top, people are spending at the higher income and wealth, and so much anecdotal data on that, and so we think there's something there.
Edward.
Thank you. Edward Lawrence with Fox Business. So, Mr. Chairman, I want to take another crack at the further reduction of rates is not a foregone conclusion. So in December, he said, far from it. So if a cut might not be on the table for December because of lack of data, what does the other concerns then stem from? So if it's not lack of data as the reason December is not a foregone conclusion, what other things could be the concern then? Well,
the perspective is of people on the committee that, you know, we've now moved 150 basis points, and that we're down into you know, you're into that range between 3 and 4, where many estimates of the neutral rate live in that 3 to 4% area. You're there now. You're above the median number for the committee, but I think there are people on the committee who have higher estimates of the neutral rate, and that's you know, you can argue these positions since it can't be directly observed, the neutral rate. So, you know, I think for some part of the committee, you know, it's time to maybe take a step back and see whether there really are downside risks to the labor market, or see whether in fact the growth that the stronger growth that we're seeing is real. Ordinarily, the labor market is a better indicator of the momentum of the economy than the spending data. That's the lore. In this case, that gives a more downbeat read. So people just have, you know, again, we've cut 50 more basis points in the last 2 meetings, and there was a sense like, from some, let's pause here, kind of thing, and a sense from others wanting to go ahead. But that's why I say differing views, strongly differing views.
So on that division, then, you're talking about going forward. So what's more important in this division? Is it inflation risks? Is it employment risk? Or is there a deeper philosophy division among the board?
Look, everybody on the committee is deeply committed to doing the right thing to achieve our goals, maximum employment and stable prices. You have differences on how to do that. And as I mentioned, some of that is different forecasts, but a lot of it is also to the different variables, which is common through, you know, through all Federal Reserves. People just have different risk tolerances, let's say. So that leads you to people with disparate views. You will know that from the speeches you've been listening to from my colleagues. And so we're at a place now where we have, in fact, cut 2 more times. And, you know, we're 150 basis points closer to neutral, wherever that may be, than we were a year ago. And so there's a growing chorus now of feeling like maybe this is where we should at least wait a cycle, something like that. That's what it is. It's just what you think it would be. It's and again, you've seen it in the September Summer of Economic Projections. You've seen this in the public remarks of FOMC participants, and now I'm telling you that's what you can expect that in the minutes, and I'm just telling you that's what happened in the meeting.
Elizabeth.
Thank you so much. Elizabeth Schulze with ABC News. What is your explanation for why the job market is weakening right now, and what will this rate cut do to improve the job market?
So I think there are 2 things affecting the job market, and One of them is just a dramatic reduction in the supply of new workers. So, and that's two things. That's declining labor force participation, which is a cyclical thing. And then there's declining immigration, which is just a big policy change that actually began in the last administration and it has been accelerated now. So a big part of the whole story is that supply side story. Okay. In addition, labor demand has declined, and you know, so the unemployment rate has gone down, meaning that demand for workers has gone down a little more than supply. So that's what's going on, but it is mostly a supply function. It's mostly a function of the change in supply, I think, and many people think. So the question then is, what does the our tool do, which supports demand, and and I would just say, when you're in a situation where job creation, if you adjust for likely overcounting in the way that BLS does its work, is pretty close to zero. So maximum employment doesn't, on a sustainable basis, if you're creating zero jobs, if it's in equilibrium, if it's in balance, it's a pretty, as I said before, a pretty curious balance. So, I thought, and many of my colleagues thought, in fact, you've seen the last two meetings, that it was appropriate for us
We were
to
talking
react
about
by
that this
supporting
morning.
demand with our rates, and we've done that. We've reduced so that rates are looser. I wouldn't say that they're accommodative right now, but they're meaningfully less tight than they were, and that should help so that at least the labor market doesn't get worse. Though it's a complicated situation, and some people argue that this is supply and we really can't affect it much with our tools, but others argue, as I do, that there is an effect from demand and that we should use our tools to support the labor market when we see this happening.
You also talked about tariffs causing a one-time price increase. Should American household consumers expect that inflation will continue to go up this year because of those tariffs?
So the basic expectation is that there will be some additional increase in inflation because it takes a while for tariffs to work their way through the production chain and finally get to consumers. And we see this now from the tariffs that were put in place now many months ago. We see those effects, but if you put tariffs in effect, and they've been coming into effect consistently in February, March, April, May, and that's all happening. So that'll continue to happen for some time, probably into the spring. These are not big increases, though. These are a tenth or so on inflation. They may be big increases on a particular product that's been tariffed, but overall, these are fairly modest. I think some projections go, we're at 2.8% inflation. At that point, it becomes a higher price level, but it stops going up, if you will. Prices stop going up. They'll just be at that level. And then measured inflation will come back down to non-tariff inflation. As I mentioned, non-tariff inflation is not so far from 2% now. Now, consumers are not interested in that story. Their prices are higher. More than that, the reason they're so unhappy about inflation is the inflation that we had in 2021, 2, and 3. Because, you can say that prices aren't going up as much, but that doesn't mean people aren't feeling those higher prices from the inflation we had 2 or 3 years ago. They are, and that's, I think, a large part of why the public, if you sample people, inflation is still very much making people quite unhappy. Even, and it's nice that, that prices are not going up as fast as they were, but they're still much higher than they were. And it'll take some time for that effect to wear off. As real incomes rise, it will feel better over time, but that's going to take time.
Michael McKee from Bloomberg Television and Radio. Do you have any concerns that equity markets are or are close to being overvalued at this point?
We don't look at any one asset price and say, hey, that's wrong. It's not our job to do that. We look at the overall financial system, and we ask whether it's stable, whether it could withstand shocks, right? So, banks are well capitalized, while some households are clearly under stress. In the aggregate, households are in good shape financially, relatively manageable levels of debt. At the lower income spectrum, you are seeing rising defaults, particularly around subprime auto, but nonetheless, in the aggregate, pretty good. And you don't see too much leverage in the banking system or the financial system. It's a mixed picture, but it's not an overly troubling picture. And again, I'm not, it's not appropriate. We don't set asset prices. Markets do that.
Well, you must be well aware that by lowering interest rates, you're contributing to additional asset price increases. And I wonder how you balance the idea that lowering rates would help the labor market with the reality that it seems more likely to be stimulating increased investment in AI, which is the rationale for thousands of job cuts that have been announced in the last few weeks.
Yeah, I don't think interest rates are an important part of the AI of the data center story. I think people think they're great economics in building these data centers, and they're making a lot of money building them, and they think they have very high present value and all that sort of thing. It's not really about. It's not about 25 basis points here or there. We use our tools to support the labor market and to create price stability. That's what we do. That's our two jobs, right? So we're here by lowering rates at the margin, that will support demand, and that will support more hiring, and that's why we do it. Now, no 25 basis point or even 50 basis point hike is going to be a dispositive thing, but ultimately, lower rates will support more demand, and that'll support hiring over time. And of course, we also have to be careful about this, which is what we've been doing, because we know where inflation is, and we know that, I've told you the story. It's a complicated story, but this is the best assessment that we can make. Because there's uncertainty around inflation and the path ahead for inflation, that's why the pace we're going has been a careful one.
Victoria. Hi, Victoria Guida from Politico. On AI, I'm just wondering, it seems like a lot of the economic growth that we've been seeing is fed by investments in AI. So how worried are you about what a sudden contraction in tech investment would mean for the overall economy? Is there enough strength in other sectors? And specifically, are there any lessons that you take from the 1990s in how you might approach what's happening right now?
Yeah, this is different. In the sense that the companies that are so highly valued actually have earnings and stuff like that. So if you go back to the 90s and the dot-com, these were ideas rather than companies, and so there's a clear bubble there. Whereas I won't go into particular names, but they actually have earnings, and it looks like they have business models and profits and that kind of thing. So it's really a different thing. The investment we're getting in equipment and all those things that go into creating data centers and feeding the AI, it's clearly one of the big sources of growth in the economy. Consumer spending also, though, has been, is much bigger than that, and has been growing, and has defied a lot of, negative forecasts, continuing to do so this year. Consumers are still spending. Now, it may be mostly higher-end consumers, or maybe skewed that way. But the consumer is spending, and that's a big chunk of what's going on in the economy, substantially bigger than AI. You can point to growth. I mean, actually, maybe growth as opposed to level, but consumer spending is a much bigger part of the economy.
And why do you think that the labor market is slowing so much, even though consumer spending is strong?
Why has it slowed so much? Well, what's happened is that the supply of workers has dropped very, very sharply due to mainly immigration, but also lower labor force participation. So, and that means there's less need for new jobs, because there isn't this flow into the pool of labor that, where people need jobs, because there aren't those people now. So there's not a supply of workers showing up for jobs. In addition, demand has also gone down, and so has labor force participation has declined, which is more of a sign, in this case, of demand as well as trend. So I think you're seeing some softening. The economy's growing at a slower rate than it was, 2.4% last year. We think around 1.6% this year. It could have been a couple of tenths higher if not for the shutdown. And of course, that will reverse. But you still got the economy growing at a moderate pace.
Andrew.
Hey there, Andrew Ackerman with the with the Washington Post. I wanted to ask if you could elaborate on how you think about policy in the context of the data drought. Does it make you inclined to stick with your plans as set out in September in the absence of the data that might change your mind, or does it make you inclined to proceed with added caution because of uncertainty?
Yeah, well, we'll know when we face that question, if we face that question. It'll probably be argued both ways, right? But I've said a couple times here that, if you really aren't getting information you really don't know, and the economy looks like it's solid and stable and hasn't really changed, there will be an argument. I don't know how persuasive it will be, but there will be an argument that, you slow down when you can't see as far ahead. Others may argue, I'm not sure where this argument will come, but you're perfectly right that you could also argue, well, things haven't really changed, but you might not know that, So I don't know whether we'll face this or not. I hope we don't.
So a good question has been brought up in the chat. That is, with less job demand. Who said it? Less demand for workers? No. So we have the data. Going back 15 years, normal would be 3.5 million jobs available. Right now, there's 7.2 million jobs available. And pre-COVID, it was at 7.3 when it was unbelievably, ridiculously red hot. So quantitatively, I don't buy your theory. What do you mean less jobs?
I hope by the time of the December meeting, we're getting, a better flow of data. But if we're going to have to do our jobs one way or the other.
Okay. I also just wanted to ask a FinReg question. I think several years ago you said the overall amount of capital in the system was about right. As the Fed moves forward with a revised Basel proposal, potentially changes to the GSIB surcharge, has that changed at all? Or are you planning to significantly reduce the amount of capital in the system? Thanks.
So there are discussions going on, I think, among the agencies, and I don't want to get ahead of those discussions. I continue to think that the level of capital, when I said that in 2020, was about right. And of course, there's been much capital added since then through various mechanisms. But I look forward to I know those discussions are really just getting going. They haven't come to the point where they're got a whole plan and that kind of thing. So I really don't have much to say on that.
Brian.
Hi, Chairman Powell. Brian Chung with NBC News. Is the weakness in the jobs market accelerating, and who's at risk if the interest rate cuts are not the effective medicine for a further slowdown in the labor market?
So we do not see the weakness, as you put it, the weakness in the job market accelerating. I would say, and again, we didn't get the September employment report, payroll report, but we look at, the unemployment insurance claims, initial claims are reported at the state level, and we still get those, and we can accumulate them and get the national number. And there's really, there's no story. You can look at the numbers. Same thing with the job openings we get from Indeed. There's just no story over the last 4 weeks. It's kind of stable. So you don't see anything that says that the job market is, or really any part of the economy is making a significant deterioration. Don't see that. You see more things like I mentioned, though, which is you see big companies making announcements of either of layoffs or of the idea that they won't need to hire. Their number of employees is not expected to go up over a number of years. There may be different people working there. They say that too, but they don't need a bigger head count. So you see those kinds of things. You don't see it in the aggregate numbers. The layoff numbers have not gone up, but job creation is very low. And the job finding rate for people who are unemployed is very low. But the unemployment rate is very low as well. 4.3% is a low unemployment rate.
So as you make these cuts, is it the lower income workers that you're thinking about, or those who might have their jobs automated? Is there a particular section of the labor market that you're particularly?
So we can't, our tools don't allow us to target any demographic or any income level and that kind of thing. I do think that people we saw this during the global financial crisis and the long recovery. If you have a long period of very strong labor market conditions, it benefits people at the lower end the most. The last 2 or 3 years of that long expansion, people at the lower part of the income spectrum were getting the biggest benefits, and lots of things were happening in that space demographically, which were very constructive. And we're not at that place right now. But so, yeah, a stronger labor market is the best thing we can do for the public. It's also part of our job. It is half of our job, but it is absolutely the best thing we can do for people. Along with keeping prices stable. Those two things. Inflation also hurts people on fixed incomes more than other people.
Courtney. Hi, Chair Powell. Courtney Brown from Axios. As you know, the 12 Reserve Bank presidents' terms are up for renewal at the end of February. I'm wondering if you can give us a timeline for when the board will consider those reappointments and whether we can expect everyone to be re-upped or if we can expect some changes.
So it's a process that we go through under the law. The way the law works is we have a reappointment process every 5 years for all of the reserve, each of them and all of them. We're in the middle of that process, and we're going to complete it in a timely way. And that's really all I can say.
Okay, thank you.
Daniel.
Daniel Davis, Agence France Presse. You've now had dissents in 3 consecutive FOMC meetings, but in this meeting you had dissents going in both directions, and you've just mentioned there's strong disagreement over the future path of rate cuts. Have these disagreements complicated your role presiding over the FOMC meetings, and if so, how?
I wouldn't say that, no. I think you have to take what comes. And what
According
comes right
to
now is,
factory production
pretty
and
challenging situation.
utilization, we're about normal.
First of all, we have 4.3% unemployment.
And it doesn't look
We have an
like it's
economy that's
falling.
growing close to 2%. So, overall, it's a good picture. It's a good picture. But
In fact,
in terms of
Aiden has it
policy,
going up and
we have
stabilizing. So
upside
the
risks to
opposite.
inflation, downside risks to employment, and this is a very difficult thing for a central bank because, one of those calls for rates to be lower, one calls for rates to be higher. We can't do both, so we have to balance the two. And so it's a challenging thing, and as we have worked our way through this process, you would expect that there would be a range of views across the committee on
Durable
what to do
goods
and
seems
the speed
about
with which we should
average.
do it. And that's what we have. That makes a lot of sense to me. All of these people are, people who take their jobs very seriously, work very hard at this, and just want to do what's right.
Make sure you're not trading your
Different views
opinion.
on what that is. And, it's an honor to work among people who care that much. It is, but I don't feel that it's unfair or anything like that. It's a time when we're making quite difficult judgments in real time, and I believe we'll get through this, and I think we've done sort of the right thing so far this year. I think it was appropriate for us to be careful about this. I think it would not be appropriate to just ignore or assume away the inflation issue. At the same time, I think the risk of higher, more persistent inflation has declined significantly since April.
Well, Aiden projects 6 months in advance.
If we do wind up resuming rate cuts at some point.
More than
at
that,
some
it's a
point,
guess.
I think we're trying to get to the end of this cycle with the labor market in a good place and with inflation, on its way to 2% or at 2%. So that's all we're trying to do, and we're doing it under, quite challenging circumstances and doing the best we can.
We'll go to Jennifer for the last question.
Thank you so much, Chair Powell.
I've
Jennifer
added the
Schonberg,
10-year
Yahoo
break even.
Finance. Both regional and large banks have taken losses on loans given delinquencies on subprime auto loans. JP Morgan CEO Jamie Dimon warned, when you see one cockroach, there may be more likely. I'm curious how the Fed is looking at these loan losses and if it poses risks to the financial system or the outlook for the economy. Is it a warning sign?
So, we're obviously, we watch these things very carefully, credit conditions very carefully. You're right. You've seen rising defaults in subprime credit for some time now, and now you've seen a number of subprime credit, automobile credit institutions having significant losses, and some of those losses are now showing up on the books of banks. We're looking at it carefully. We're paying close attention. I don't see at this point a broader credit issue. It doesn't seem to be something that has very broad application across financial institutions. But, you know, we're going to be monitoring this quite carefully and making sure that that is the case.
And then separately, many, you yourself have said that we're in a bifurcated economy right now with high net worth individuals continuing to spend with the lower income pulling back. How much of consumer spending continuing hinges on the stock market remaining strong? In some odd way, does the market help keep the economy buoyant?
So there's some relationship there, but remember, the more wealth someone has, the lower an additional dollar of wealth matters. So your marginal propensity to consume declines quite dramatically as you reach levels of stock market wealth. So, you know, the stock market, it would affect spending if the stock market went down, but it wouldn't drop sharply unless there were quite a sharp drop in the in the stock market. People at the lower end of income and wealth have a much higher marginal propensity to consume of an incremental dollar of income or wealth, but they don't have the stock market wealth. So I think it's certainly a factor supporting consumption right now. But and you would see it if you saw a material correction in spending, but it wouldn't be. You shouldn't think that it'll, you know, dollar for dollar stop consumption, because that wouldn't be the case. Thanks very much.
Cool. So that's that. Pretty much as we expected. Yeah, going back to Liam's comment, you know, you have to have a plan. So one of the things I've been working on with Aiden, and we glitched it today, so I added our history so that you can go back and review the transcript from your conversations with Aiden. And you're like, wait, what conversation? So Aiden is designed to take all this data that you see displayed, right? Now, Sky Killer says one less cut. Well, remember what I said in January, that there would be a cut in September and a cut in December. So if they do September, October, and not December, then it's exactly what I said. Not exactly, just the same amount. But anyways, going back to this, I've been teaching Aiden Socratic method of dialogue, and with the purpose of asking you questions, and I've been teaching it to give, instead of just asking endless amounts of questions. That's not helpful, and it seemed like that's what it was trying to do earlier today. So I've been teaching it to give you feedback, like ask questions, you give answers, and then it says, oh, have you looked at this? Have you thought about that? And the whole thing is designed around a process in which it creates an investment or trading strategy around your ideas and your philosophy. It doesn't just tell you what to do. It'll ask you a bunch of questions and give you some feedback, and ask you some more questions and give you some feedback. And together you design a trade plan or a strategy, depending on your time frame. So it'll ask you, like, are you looking at your charts? How long is this trade going to last? Is it a couple hours, couple of days, couple of weeks? Like it's really quite intelligent. And then so Aiden will ask these questions and it'll give you feedback. So if you're like, well, I want to buy it because of, you know, something on the chart, it'll say, well, did you look at the annual pivot point? Do you realize you're buying right in front of it? Oh, I didn't. Oh, okay. And then so it'll go through, and then the output it'll give you is your trading strategy based on your rationale after having a conversation with Aiden, who has a master's degree in economics and 30 years of trading and investing experience. That just happens to be me. I have a master's degree and I have 30 years of trading experience, and I taught Aiden, and Aiden knows precisely, let's say, my pivot points and the way that I trade pivot points. No other way. I don't even know how other people trade, so I've never cared. So I've taught Aiden. Okay. So it'll create this trade plan with you, your trade plan with you, fleshing out ideas and giving you feedback so that maybe you can tweak your idea if you Like maybe you don't want to do it if it's right in front of an annual pivot point that you missed. Good. So then when it's all done, you'll have a structured trade strategy based on fundamentals, technicals, institutional positioning, seasonality, market sentiment, and all this stuff. And then Aiden will share his trade plan based on the asset that you're interested in trading, which may be similar or quite different or even the exact opposite of what you're doing. And he'll then explain his rationale through all the data points and then compare your trade plan to his trade plan, do that comparative analysis, give you output, and then a confidence score in your trade plan and why. Just on this page. And therefore, you can go in and rename these, and you can have all these as your trade plan. So be ready. It's designed to teach you how to structure a logical trading and investing plan based on quantitative data and technical analysis and seasonality and fundamentals and sentiment. It's designed to teach how to do it, and then you do it together. So it doesn't just spit out answers like, you should buy gold. You will learn how to become a better trader, the strategy and logic, but without this endless loop. But don't expect it, TRADARS, just to tell you what to do. This is a platform for traders. So it's going to take a while for you to get used to it, but I don't want TRADARS 2.0 to be a data dump. Like, look at all this data. Isn't this great? Oh, you want to look at the 30-year bond? Oh, great. Isn't this great? And you're like, I don't understand. So the whole site is designed while you can pull up the 30-year, and Aiden will tell you what this means. Okay? On every one of these, Aiden is telling you what it means, translating. So you can see it, you can manipulate the data, okay? But you always have someone there to explain. So that's really good. You'll have the data, but again, that's just for you to look at and get comfortable with and do your research and all that kind of stuff. Here's corn prices. Yeah, we track corn now. Yeah, that's for sure. Okay, that helps you with your exports because we're trying to calculate X minus M in GDP, right? So then you have all of this data, but all of this data is actually designed just to feed Aiden's neural network. So now Aiden has all of this in his brain, and I've taught him what each individual component means. Risk on, risk off, good, bad, strong dollar, weak dollar. Okay? And then AI is really good to say, if Aiden has been taught good, bad, strong dollar, weak dollar, risk on, risk off, for 500 variables, AI is really good at just being able to go, boom, oh, slightly risk on, or very risk on. And we're not very good at that, are we? So for those that say, well, Wayne, all of this is impressive and it's pretty and the colors are cool, the reports are great, and I can manipulate things, and then I can get, all these different future things, right? So there's projections into the future, as you can see here if I zoom in. See, that's the projection into the future. Oops. Someone was talking about a year in advance. We don't do it that far out because we don't, at the farther out you go, the more guessing. Okay? And you're like, I love the fact, Wayne, that we have yield curve analysis and money is moving in and changing the shape and all that. But what does it mean? How do I put it all together? Right? That's the next question, isn't it? You're like, great, I'm glad I have all of this, but how do I use it? Especially if you don't have a background in economics. Well, I do. I taught Aiden. Aiden does. And so you'll be able to ask Aiden. Now, we give you hints all the time. Throughout the website, we tell you basic tidbits of what it means. And then you can ask Aiden to describe it to you. Now, this may or may not actually work. Click that button. I don't know what it's doing. Oh, yeah, it shouldn't have done that. Yeah, so anyways, I got to fix that. But what I'm getting at is at the end of the day, all of this stuff that we're looking at isn't actually for you. Now you can access it whenever you want, but I want you to understand the complexity of what's going on here. The multi-dimensional analysis that Aiden is doing is pretty extraordinary. Multiple time frames, multiple asset classes, multiple, I mean, I don't know, it's 5, 6, 7 dimensional thinking versus what we used to do is if dollar is strong, that's risk off. Now we might look at 24 variables, including the strong dollar, and to discern what really is going on. Yeah, like it's really, really complicated. And so, boiled down, when you boil all this down, guess what happens? You're just going to have a conversation with me. Now, it's not me. My name is Wayne. It's not Aiden. I didn't want this to be a fake Wayne. But now you have access to Aiden 24 hours a day, and Aiden is conversational. You will have conversations. You will ask questions. You'll get results, but you'll also get questions back, and he'll adjust. He'll think about the consequence of your response and change his questions and change his output and change it. And it's literally like you and me talking about building a trade plan around you and your ideas. And maybe it'll be easy, but maybe it'll be complicated where Aiden will show you things that you haven't even been thinking about. You haven't even looked at. You feel like gold is going to go up. You saw a guy on TV that said gold was going to go up. But then what if Aiden said, well, did you look at GDP? It's higher than inflation. We have 3.8 GDP and 3.0. So why would you buy gold? You're like, oh, well, we're hedging inflation. Yeah, but inflation's falling. Why would you be, what are you hedging? Falling inflation? You're supposed to be hedging rising inflation, right? So if Aiden popped that up, and then what I actually want him to do is say, bring up the chart. Did you see this? Look, inflation is dramatically falling. And now, right? So if inflation is falling and GDP is stable, and the Fed is cutting interest rates that should increase productivity, what is it that you're hedging? And you might go, oh my God, I never thought about it that way. That's the idea that the Socratic method of dialogue, where by asking questions and actually doing work with you, you will learn. It's not a machine just to tell you what to do. You will learn through the interaction and the development and creation of your own trading strategies around your own logic. But you'll get better and better at building better logic. So going to TRADARS 2.0 is not an upgrade, it's a revolution. Okay? It's an absolute total revolution. And I think what we'll find, especially as I improve, I have a lot of work to improve. And I just messed up Aiden, so it's probably not working very well right now. But over the course of the next few days, few weeks, few months, you're going to spend more and more time with Aiden. And you will become a better investor and trader. You will. Because you have a mentor and a guide like a senior trader that you can bounce ideas off of whenever you want and about whatever you want. You trade oil, that's good. You trade treasuries, that's good. Trade gold, Bitcoin, good, good. You got that. Okay? So, anyways, the world has just changed, everybody. The world's changed. Yeah. So I'm running a special if you want to sign up. Here comes the big sales pitch. It's $2,400 a month, exactly the same as Bloomberg Terminal, but Bloomberg doesn't have AI like this, so it's TRADARS is way better. But we're running a special. Buy 1 month, get 11 months for free. So you buy 1 month for $2,400, and you get the other 11 for free. Or if you prefer, why don't you just pay the $200 a month and get everything? Because now I'm being facetious. No, it's not $2,400 a month. It's $200. And you get me and Aiden. But if you hate my personality, you're like, dude, Wayne's smart, but I can't stand him. Go with AI alone. So you get everything but me. Okay, so you can cut me out of the equation. You can have all the data and the AI. You don't even need me. I'm telling you, you don't need me anymore. I'm obsolete. I actually breathe. I actually think. So you don't need to pay for that. You have AI. He doesn't breathe. Aiden doesn't breathe. No, no. David's price is going up to $1,000 a month. Yeah. No. Live coaching. So it's not just me. It's the rest of the team. Yeah. Now it's been a little glitchy as I've been doing things. Lots of things have been a little glitchy. Don't worry. In days, in a week, it'll all be ironed out. This is a big change. Technology is completely different. Everything's been redesigned. All the code is new. But the idea is you still get the full team. David did a presentation last week. Brian did a presentation last week. Okay. Yeah. Okay. And even by the way, there's a free. I think you saw that, right? There's a free membership. It includes the Squawk Box for free, which many people pay $100 a month for, using other services. You'll get the market, most of the market. Okay, I have to update this. This page isn't. That's going to be. It used to be my YouTube video. I don't know why it's loading. The free account will also include the scalping radar for Forex, for commodities, and for individual stocks. And you get the volatility radar. That's all in the free account. Yeah, Peter, email me. I'll get you all put together. Peter's got to do his and all that kind of stuff. Do his webinars. So, yeah. So the point here is even the free account has legitimate real value. It provides real resources that will help. It's not like a little trial or something like that. Yeah, it's real value. Like this page alone, a Squawk Box. There are many services that charge $100 a month or more. This is in our free account. Then if you want a little bit more fundamental, like if you want more, it's more than a little more. But if you want more access to more data than the free, look, I made it less than $1 a day. So I unlock a lot of the fundamentals. I unlock the COT analysis, and you get the Squawk, and you get the vol, and you get the news radar. That's what's missing. I wonder what that gap was. We've had this gap all day. Look, it's actually there. If it'll work. Yeah, I forgot to say. This is also included in the free account. It's just the tab is hidden. For some reason, Aiden took the text out. So there is a lot, as Trump would say, a lot of value for free. A lot. It was important to me to give a lot to the free member. If you want the fundamentals, much of the fundamentals, less than $1 a day will give you pretty much everything. If you want to just have, a solid fundamental foundation and that's all you care about, or you don't have a lot of money, I got you taken care of. So that unlocks a whole bunch of the fundamentals at quite a good level. Once you get Data Max, it just unlocks all the data. And then when you get to the AI levels or higher, it starts doing like Aiden will start explaining things. Aiden will start doing forward projections for GDP, forward projections for PCE, CPI, forward projections. And I haven't even gone through it yet, but seasonality now is ridiculous. What I've done for seasonality, I'm not going to show it to you because I'm pretty sure there's a color. Well, why don't I just do it? I think Aiden screwed up the color earlier today while we were working on something different. Okay, a little better. Seasonality is crazy. Okay. Now I have to update the data, so I think all of this is from September because I built it that long ago. I have to double check. I don't even know, but don't follow this advice right this second. Later today or tomorrow or this weekend, I'm gonna go back to our data providers like the Fed and we get all our data by the way. All our data comes from government agencies. We don't pay a data provider. This is all directly from the Fed or from the Bank of England or the Bank of Canada or the Reserve Bank of Australia. We even talked to the Bank of Japan, like seriously, right? So anyways, don't follow this, but look at the idea here. Oh yeah, September. There you go. I should probably have it say September 7th. Okay, think about this. Back in September, this is what you knew. Bitcoin, right, is strong. S&P 500 is very bearish. Gold is strong. Euro dollar is down. Dollar is mildly strong. And WTI is bearish. Isn't that cool? So we're heading into November 1st, and by the time we get there, this will all be fixed. So when you log into TRADARS, it'll tell you the biggest winners and losers projected for the month based on seasonality. So look at buying Bitcoin in September, look at selling the stock market in September. Isn't that neat? Then we have a lot of cool things going on here. One of the cool things is this dotted blue line. Okay. If you have access to Aiden, Aiden will add this blue line, and it's the prediction of the stock market between September, which was here, and to the end of the year. And so by October 1st, Aiden had said he expects the stock market to rally to the end of the year. And guess what it did? Aiden was wrong. The pullback was really slow. But then since October, it's been up the whole way. And Aiden said from October to looks like the second week of December, the stock market goes up. And the rest of the things are ranges and standard deviations. But the other thing, it's telling you what September usually does. Then Aiden is thinking about what happens in October. We never did this before, to think ahead. And then Aiden helps you understand how to think ahead. That somewhere, right? Somewhere there's a shift from bearishness to bullishness in the S&P 500 somewhere in September. So September is a bad month for the stock market, no doubt about it. But somewhere in that bad month, it turns very good and stays good. And Aiden will help you understand. Okay? But check this. You ready? Current month, September patterns, the S&P 500. 3 out of 6 years, it's been up. So 50% of the time it's up, 50% of the time it's down. On average, it's negative 2%, which means the up years are not very up, but the down years are very down. Volatility range, you can lose 7% or you can gain 3%. Well, I already did that in my brain. But the down months are very down, and the up months are modest. And it's 50-50, so it's not a good month. But check this out. The next month, because remember, you're doing this in September, it says, hey, get ready, because October is really good. 67% of the time, it was a good month. Okay? And from the base, right, from the trough of October low to the high, right, of October high is a 4% rally. And so check this out. Recovery pattern detected. This is Aiden thinking because he's got years and years and years and years of S&P 500 data down to, I think, the hour. And we're analyzing it for all kinds of trends, technical trends, seasonal trends, patterns. Where do the peaks and troughs, the pain to gain ratios, it's doing all of this. So it can say, well, 67% of the time it's up. And if you time it, if you go long in September and not wait for October, that swing of itself is 4%. So now you have to somewhere between the beginning of September and the end of September, you should be buying for October's strategy. Okay, now it gets better. You ready? So September is a down month. So late in the month, between the 21st and the 30th, you can see that downtrend completion, some consolidation, and some early positioning ahead of October. So it's telling you somewhere between the 21st and 30th day of September, you should be looking to go long on your October strategy. And this is what I've been teaching for 100 years. And by the way, I didn't teach Aiden that you should buy the S&P 500 in the third week of September. I've taught all of you of that rule. And you just happen to know the rule might be true because Wayne taught you. And you're like, well, I don't know if it's true. Wayne might be full of BS, but that's what he says. Aiden, after me teaching economics and giving him all the data, I said, go back and find patterns. I didn't say go prove this. I didn't even mention buying the stock market in the third week of September. I want you to fully appreciate this. I've been doing that for 25 years. I did not that's not how I taught Aiden. Instead, I taught Aiden. And then Aiden went through 25 years of hourly candles. Put that in your pipe and smoke it, huh? 25 years of hourly candles. And then I asked Aiden to look at for certain types of patterns like changes and peaks and valleys and all that kind of stuff to try to prove seasonality. I didn't give him a data set to say, this is what seasonality is. This is all new math. This has nothing to do with the old Traders 1.0. This is all new math. And so his math first said September is a negative month, October and November are positive months. Well, I already know of that. That's what we had before, so you already know that. But what we lacked in 1.0 is that, well, when should you buy the dip and front run October's rally? Well, we didn't have that data, and that would be quite complicated to do because you have 20-something years of this data. And so instead, I said, look at all these millions of candles and tell me if I know September's down and October's up, when in September should I buy? So he went back, looked at all the millions of candles, looked at that period. So let's say the September to October period over 25 years and said, you know what? Somewhere between the 21st and 30th. Bingo. Now, the thing is, that's what my brain knows to be true, or at least what my brain believes to be true. Aiden did it from data on his own. After I taught him what to look for, he went out and looked at the data and found the pattern that I already believed to be true. Dude. Oh. So in a weird way, you don't need Wayne anymore. You can save the $50. So when we roll into November, it'll tell you what November usually does and what you should be trading, but it'll also prepare you for December and how to get involved and even when to get involved. And you have this for every asset that you can ever imagine, not just the S&P 500. Oh, well, what about Ripple? Good question, bro. Bruh. Hey, bro, what about Bitcoin? Yeah. Hmm? Okay. So anyways, cool, right? And I'll make this even prettier than it is now. So anyways, my goodness, ladies and germs, an absolute total revolution. Yeah, an absolute total revolution. You mix that with a good broker like Trader's Way, you got good charts. So one of the things I'm going to do is embed all my chart templates so you can have all of this on your charts. I got some other ideas. I've actually tried some cool things and they failed, unfortunately. Wasn't able to technically do what I thought I was able to do, but I'll keep trying once I have time. But this is a revolution in how you should be thinking about trading. There should be no guesswork, no opinion, none of this. I feel about this, I worry about that. This is what I think about Bitcoin. Everything you do is going to be based on logic and intelligence. And in fact, if you work with Aiden, imagine every single trade you make, you had to go through a 10-minute interview process with a senior trader and economist. And you flush out your idea before you even pull up the chart. And by the way, Aiden does have charts in his brain. Aiden sees charts. He sees moving averages. He sees pivot points. I taught Aiden, actually, do you remember this? Like 3 years ago, I taught Aiden technical analysis in the first iteration of TRADARS, which was tradeplans.ai. So I'm in year 3 of building this, right? So it's really good. So imagine now you have that interview process with your senior trader and economist, and he's going over your charts, he's going over your fundamental strategies and opinions and biases, and confirming or denying or challenging or really getting you to think about what you're doing before you even go to your chart. Yeah. And like I said before, he might see a pivot point that you missed because you're on the 15-minute chart, and he might be able to look at the hourly, the 4-hour, and daily all at once. And he's looking at daily, weekly, monthly, and annual pivot points. And you might not be looking at your annual pivot point. You might have missed that. And Aiden won't. And if you need a human, we have a team of some of the best humans I've ever met. And they happen to be fantastic traders that make a living trading. You can ask me and you can ask them. Jimbo says, could I do it? Like, can you, I think what you mean is, can you use AI to program the strategy into trading? Maybe, but that's not a belief of mine or an intention. One of my beliefs, one of my core beliefs, Jimbo, and maybe I'm just an old dinosaur now, but I enjoy the work. I enjoy trading. I enjoy the research. I enjoy the banter with other traders. And one of my core values from the very beginning is I'm not looking for ways to do less. So people have asked me forever, well, Wayne, can't you just, build an an EA around your trading, like using pivot points or moving averages and stuff? Yeah, you probably could. I'm not interested. See, that's the most boring part of trading for me. And use it for confirmation. Like, I'm just not saying no, but my core value is I enjoy doing the work. I enjoy the trading. I mean, honestly, I enjoy traveling around the world with my laptop and trading. It makes me feel good to sit by the swimming pool and trade, right? Right? So I'm not looking for ways to stop that. I enjoy being a trader. I enjoy all the processes. So I'm not trying to cut corners. I'm trying to do more with less time. I'm trying to do more, not less. And Traders 2.0, I can't imagine there's anything better in the entire world, honestly. Yeah. I honestly believe it's the best thing in the entire world for traders and investors. And it's a revolution. Yeah. 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 I'm not sure. I don't have the schedule in front of me. But if you have paid access and you're not getting access or you're not getting full access, email me, wayne@traders.com. Okay. If you log in and you only have access to the live coaching, but you don't have access to anything else, your membership has expired and you haven't been paying. So you're going to have to up. You're going to have to re-up. Yeah. Because one of the things we had to do is delete the entire database and build a new database. And I build it based on people's payments coming through Stripe. So I'm like, oh, all these people have all these products and map this product with this level of access at TRADARS and give everybody access, right? So it did that. Great. So if you're paying, I mean, there are a lot of people still on QuantBox. Well, if you have a QuantBox account, you have a TRADARS 2.0 account. Okay. Yeah, I know, Richard. Email me, wayne@tradars.com. Okay. So I'm not saying people did this intentionally, but some people had basically, they were not paying for access to TRADARS. Their membership expired, and for whatever reason, it didn't cancel. Mostly, I think what happened is I gave people opportunities to move over when we were using QuantBox, and it didn't unexpire them when they stopped paying. So that good fortune for you is over because I've deleted the database. But if you have a paid QuantBox subscription, you have access. If you have a paid TRADARS subscription, you have access. Right? Yeah. Pretty simple. So we'll fix all that. Just, all this stuff is complicated. It's cool. I'm not angry. I'm not mad. But yeah, but this is all good. Yeah. So anyways, life is great. Life is good. Life is beautiful. Thank you for being in my life. And I hope you're amazed. And the thing is, most likely as you continue to use TRADARS 2.0, you'll become more amazed than you are now because you'll start to get a glimpse of the depth. Like I said, it's multi-dimensional decision. It thinks in some cases about dozens of different things and the consequence of each thing, and then be able to put them together logically in an investment and trading strategy. It's incredible. It's incredible. It's so good that the machine will help you become a better trader. And that is the whole raison d'etre. That is the whole point. This is about making you better at what you do and loving the career of being a professional trader and investor. Peace.